What is up, people? I am back with another episode here, and I am bringing you guys, as usual, I think I do this all the time, but I'm bringing you guys a great guest today. At the time we're recording this, I had the opportunity to be on his podcast just a few days ago. So when this drops, it'll be a little bit older because we got some other ones in the bank right now, but go back and I'm going to introduce our guest here in a second. Before I do that, though, I'm going to get into today's sponsor, as I do on every episode, and that is Wisconsin Discount Properties. We are bringing you guys deals to your inbox every single week, 6 a.m. It hits your inbox. So if you're looking for off-market real estate and you're not on our buyers list, what the heck are you doing? So get on the list, go to the website, put your information in. What we're also doing right now is we are giving away our Burr for Beginners course. So this is a huge opportunity, guys. If you're out there and you're looking to get started and you want to do the Burr process and you're not sure where to start, this is an action-oriented course. So it's not just education. You're not going to come in here and learn the fundamentals of it. You're going to actually be in and forced to take action to get your first deal in the first 45 to 90 days of taking the course. So to get the course for free, join the buyers list, and somebody from our team will get on a call with you. And after that call, we'll get you the discount code to get there. All right, let's get into today's episode because I got a gentleman here who's got tons of experience and is going to bring you guys something we haven't had on the episode yet, which I'm pretty excited about. So I have Mr. Scott Carson with me, who is the owner and manager of WeCloseNotes.com. So he's based out of Austin, Texas. So we got nothing against Texas here. We love Texas. Great place. So not a Wisconsinite, but this guy does business all over the country, guys. He's got the Notes Closer Show, which has millions of listeners across 130 countries. So this guy knows his stuff. He's got tons of people that follow him. He does an online summit and a conference called Note Camp, which you guys can get access to as well. There's a ton of other things. So we're going to dive into the note world a little bit today, raising private money, short sales, non-performing notes, all kinds of fun stuff. But with that, let me bring in Mr. Scott Carson. Scott, how you doing, buddy?
I'm doing great today, Corey. Excited to be here. We were talking about Tampa last week, so I had to wear a Tampa shirt here for you. You know, pink flamingos all over the place here for you, man.
My man, bringing it. I love it, buddy. I love it. Well, I'm excited to have you on, man. We had a great time recording on your podcast, and so I'm super excited to bring you to our audience and get to flip the script a little bit with you today and be the one asking the questions today. So tell the audience a little bit, man. You've been in the game for a long time. You know, can you remember back to when you started and what it was that had you even getting into this crazy world we call real estate investing?
Yeah, I can. I mean, it's like many folks reading Rich Dad, Poor Dad and deciding you want to do something different and then going and network at the local real estate clubs. And I actually bought a couple investment properties on my own without any training or education and fell flat on my face, you know.
Okay.
That's a little bit of like, I thought I knew everything because I grew up in a hardware store down in South Texas. Okay. My dad, so I thought I could be like Tim the Toolman Taylor and fix everything. You know what I mean?
The young audience has no idea who Tim the Toolman Taylor is, by the way.
Exactly.
Yeah.
Benford Tools, baby. You know what I mean?
That's right. Oh, man.
But no, I mean, I fell flat in my face like some folks do. The only person that made any money was a realtor, stuff like that. So I licked my wounds for a couple of years and was fortunate enough to, you know, get our assets out of a sling, as I like to joke, from being a distressed bar to getting back on track. And then a couple years went by and I met a buddy of mine who started a mortgage company with a couple, I guess, say educators and investors here locally who were traveling the country speaking on real estate. And I said, that's what I want to do. So I left banking and threw my lot in with them. And for 4 years, I had an apprenticeship with them, not only on the mortgage side, because we were doing originations for investors and stuff like that, but really learning the creative side of real estate investing all across the country from the likes of like Ron LeGrand and some of the other folks. So I remember that. And then sending out like my first batch of letters to the postcard, letters to foreclosure listings, people facing foreclosure. And the first phone call I got was this lady who hadn't paid in like a year. She hadn't had water on in like 6 months to her house. She had a huge KB home. She was letting her 4 dogs run wild throughout the house and defecating and doing all that stuff. So when you walk into the house on the carpet, it goes squish, squish. You know what I mean?
Oh, yeah.
It was so bad that the lower like 18 inches of the sheetrock was all yellow from the dogs. They were just running all up, licking her on the face. There's food that just real positive environment. You know what I mean?
Wow. And that's your first one. This is your first experience of direct to seller.
Exactly. Walking in and do that meaning she was still using the toilet. So each toilet was full of excrement, and then she was doing it in a 5-gallon Homer bucket.
Oh my gosh,
so
dude.
What's running through my head is hearing Ron LeGrand saying the smell of shit and piss is the smell of money. And so I'm like, okay, this is how it goes. Well, that was my first, I go home, showered off, and anyway, we didn't end up buying that one, but that was my first indoctrination into real estate investing the right way.
My goodness, man. So how long have you been in this game? When did you get started? When was that first experience?
Yeah, so basically, technically, I bought my first investment property back in 2001, and we failed at that, trying to be landlords, but that was in 2006 was when I bought my first, well, I wouldn't say bought it, we took over a property subject to.
Okay.
And then we optioned another one and got rock and rolling. But I sink my teeth into the distressed note side and bought my first non-performing note back in 2007 on this condo in Arizona. And I've bought, that's what I love. I love buying the distressed debt side of things without having to deal with toilet stands and trash outs. You know what I mean?
Yeah, for sure. Tell everybody out here. So what I want to do today, Scott, for my sake too, and for our audience sake, somebody this is their first time being introduced maybe to, some of the terminology you're using, that kind of stuff. Let's make this, in CRAN, third grade level. Can you explain what the heck, how do you buy a non-performing note? What is a non-performing note? I mean, I kind of know what that is, but like, just explain it in third grade terms, and how do you get access to some of these things?
Yeah, exactly. Great stuff there. So a non-performing mortgage, non-performing note is exactly like it sounds. Somebody who's not paying on their mortgage debt, like if you guys target like foreclosure lists, well, that's listed. It's a full list of non-performing notes where people haven't paid in 6 months to 6 years or longer. And so we buy that debt, not to buy the property, because I don't really own the property when I buy the mortgage debt. I literally am replacing the bank. I'm buying that mortgage debt not from the homeowner. I'm buying the actual physical mortgage from their bank or lender at usually a substantial discount. The borrower still owes what they owe. It's just swapping out one bank for another. Technically, I'm the bank, and I have all the same rights that the bank does to reach out to say, hey, Corey, you haven't paid your mortgage in 6 months. What happened? What's your country western song? Did grandma get run over by a reindeer? Did the Packers lose? Did you spend it all on Bud Light, after the loss? Did your job at the cheese curd factory lay you off for a period of time? What's the situation? And so we buy that debt at a discount. So if they, haven't paid in 6 months and they owe $200 on a $175,000 house, we would probably come in and buy it about 50 cents on the dollar value of the house. Wow. So we might pay $85,000 for that, $175,000 asset where they owe more and they're underwater. And so we approach homeowners and say, listen, hey, we know you haven't paid in a while. Before we foreclose on you, which we have the right to do you want to stay or do you want to go? If you want to stay, let's work out a payment plan, because we actually, since we bought the debt cheaper, we can be much more flexible with the borrower. Say, hey, you haven't paid in a year. Well, can you bring 3 months to the table? Can you pay your existing payment plus $200 a month to get you caught back up on? You know what I mean?
Yeah.
Or, hey, you don't want to stay. Okay, let's sell the property. Let's do a short sale, and we can accept a little bit of a loss off of what's owed, but we still bought it at a price that was much cheaper than we paid for. So that's kind of what we do. Is we get these lists in from banks, from mortgage companies all across the country. And it's going to be like 200 to 500 different notes on properties all across the United States, including Wisconsin. You know what I mean? We see some stuff up in Wisconsin, and it's we can cherry pick this stuff. Some people think you need to have millions and millions and millions of dollars, and all that does help. No, you don't have to have millions of dollars. A lot of banks, excluding like the big ones like Bank of America, Chase, Citi, Wells Fargo, you're not going to buy a one-off mortgage from them, but there are plenty of other lenders that will sell this stuff to you. And the goal isn't, I know a lot of people come from, hey, I want to own the real estate side of things, right? I want to own the property. I want to go out and touch it and rub it and replace the paint carpet. Well, I don't want to do that. I want to get paid like a bank does.
Right.
And so if you let's put some numbers to like we just talked about. So let's just say it's simple. They owe 200. It's worth 200. They haven't paid in 6 months to a year. Why the bank hasn't foreclosed already, don't know. I mean, it may be a lower valued asset in their portfolio. They may have tried to work it out. It might be in a state that's longer to foreclose on. There's a whole variety of reasons why they can sell it to us. So we come in, we see this, we like the value, we evaluate all the loan documents, the servicing notes between the borrower and the bank, see that this borrower may be a good fit. And so if we buy it at 100, and let's say their mortgage rate is at 6%, well, if they just start paying on time again, so we bought that 6% mortgage at 50 cents a dollar. If they just start paying on time, it's a 12% cash and cash return to us. Okay. If they bring 3 or 4 months to the table, that goes to a mid-teens and maybe 20% first year.
Wow.
We get the borrower back on track, making payments for 12 months. It's now considered a reperforming note. I could turn around and sell it back to Wall Street or back to other mortgage companies who are looking for performing paper at, say, 80, 90 cents on the dollar. So I've now gotten, in a year, I got some skin in the game, 3 to 4 grand, 12 months of on-time payments. If I bought it for 100, I'm now turning around selling it at 80 cents a dollar. So that's at 160 to 170, making 60 grand on the note sale. And so that's a pretty good return on a $100,000 investment. And
oh my goodness.
The nice thing that I like about note investing is you don't have to do it full time. The great thing is that there are like heavy lifters, fix and flippers, where you really got to be spot on for a lot of times, right? Meeting the contractors and knowing your people and knowing comps and time. Well, if I can rehab the borrower, it makes more sense than rehabbing the property to me, because most of the heavy lifting is actually going to be by either the servicing company that we're paying a $35 to $95 a month fee per loan to do that borrower outreach. I'm not knocking on doors trying to evict people myself.
Okay.
If they won't play ball, then we kick it to our real estate attorney in that state to do the foreclosure, and then they foreclose. And then if we could sell it at auction, sometimes we do that. If we don't sell it at auction, we take it back. Then we just bump it to our local realtor to handle the eviction, the clean out, and then the rehab side of things.
Wow. So then you end up flipping it. Worst case scenario.
We can flip it. We've held it. Once we foreclose, and if it doesn't sell at the auction, it's our own REO. We can do whatever we want with it. Owner finance.
You're controlling the property because you control the debt. So
exactly, and that's why that's why I only buy in first lien position. I mean, there's people that buy second liens and junior liens, and that's fine. It's a much riskier spot to be in, because if the first lien's not getting paid, the first lien can foreclose and wipe them all out completely. You know what I mean?
Okay. So that's the risk. So like, I'm thinking about that as raising private money, right? Like, what do I say to my lenders who have a smaller dollar amount? They want to come in and maybe they want to fund the rehab or do whatever. Like, they're going to go in second or third position potentially. For them, obviously it's a relationship thing when you're doing private money, but like, what are you communicating to those people or the people out here who are doing that as far as what to explain, to be full disclosing to their potential lenders?
So you're talking about if they're funding from a second lien position or funding a note deal?
Say I got a friend, family member, whatever. Yeah. They got 20 grand laying around. They want to put it to work, but I got a bank note on the first. The bank note's going to be in first position.
So always make sure there's a couple of things. Make sure that the first is getting paid. That's one of the most important things, because that's going to wipe you out. Make sure taxes are getting paid, because that's the thing that would wipe us all out. Yeah. First and second. And then also make sure that somebody's really not rehabbing more than you're comfortable with. We've all had deals that were maybe, the market's just, and we're at a combined loan to value of 70, 75, 80. I don't really want to get above that unless it's an emergency or something, for the most part. But try to stay at that, I guess the golden rule when it comes into it is stay below 70, 75% of the after repair value if you're rehabbing the property.
Right.
On the note side, we're only raising capital in the first lien position because that's really all that we're buying. And then we try to have the investor who funded that note fund a little bit extra for foreclosure costs and servicing and rehab if we need to.
Okay. Got it. So that was one of my other questions I had for you, Scott. So when, like you said, you don't have to have millions and millions of dollars around to do this, right? So are you raising private money then to buy the notes, and you're keeping some kind of spread or for kind of doing all the work, or how is that working as far as being able to buy, several of these, or somebody out there looking to buy their first note who doesn't have a ton of cash, but has a lot of time and grit? How are they going to do this thing?
So here's the golden rule when you're being a real estate investor is no matter if you're trying to raise 50 grand or 5 million, one of the greatest ways to find investors is networking, but also we target a lot of self-directed IRA investors, people who have used their IRA to either buy a rental property or to lend money out of their IRA. And you can literally go to the county records office or the county appraisal districts to find these investors in just about every state. There's a few non-disclosure states out there. So like we go here in Texas, or I go to Florida, one of our favorite states there. And if I go
love Florida.
Yeah, exactly. It's a lot of money down in Florida, right? So
yeah.
you can literally go to Collier County or Lee County and go to the appraisal district and just type in, say, Equity Trust, or type in Quest Trust or Mid-Atlantic. I mean, Quest is no longer around, but there's still stuff that's still floating around with them. And if you type in that in the property owner's name, it's going to pull up a list of people who have used their IRA to buy a rental property. And we all know if they're using their IRA to buy property, it's got to be passive, right? It's got to be a hands length, ideal for note investors because it's passive.
Yes.
Right? We buy a note, we get the borrower reperforming at 12, well, we borrow the money at 8. Great, we're paying our investor back there 8% on a quarterly basis. We don't pay monthly payments, just we do once a quarter, so it speeds up a little bit things and keeps IRA. But you could literally then, the great thing about going back to these county records is got the mailing address. You know what I mean? Sometimes these counties, you can actually do a few buttons and it downloads a full spreadsheet, borrower's address, name, and then their mailing address to do a mail merge.
Oh my goodness.
And the great thing about IRA investors is that we know they're investors just like you and me, right? They've got money that they need to put to work most of the time. And 3, they're always looking for deals.
Yes.
And if you've talked to most of the IRA companies and custodians out there, actually paper is one of the biggest things these people are invested in. Now, if they're lending you money, they're in the paper game, right?
Right.
So they're lending on a first lien. Well, how about you fund a first lien investment, a note deal? You're still going to get paid your interest. You're going to be either codenamed on the assignment of mortgage, which transfers ownership, not a deed. Because when you're buying a mortgage, the property doesn't change hands. It's just the lender does. You know what I mean?
Okay.
And so that's a great thing for folks now. Finding people who have lent money out of their IRA, if you go to the clerk or the recorder's office and do a same search for like Equity Trust, Quest Trust, it'll pull up and do a deed search for that. You'll pull up people who have lent money out of their IRA and who they lent the money to and how much they lent out as well. And we will do a release of lien search and do the same search. And you see people who've gotten paid back and have money sitting on the sidelines now. So it's not as easy on the county clerk side because you got to look at deeds and stuff like that. But it's a great thing to hire a VA to do and let them go off and running for it. But literally, I mean, even if you're in a non-disclosure state, like Minnesota's non-disclosure, Virginia, Maryland, non-disclosure because of government, California, Arizona aren't either, but Texas, Florida, Ohio, the land from where Equity Trust is located. Yeah. You can literally find thousands of people who have a self-directed IRA to fund your note deal or fund your real estate deal.
Right. And they don't have to be in your state. They can be anywhere.
It's a beautiful thing with a thing called Zoom. You know what I mean? So the only direct mail marketing we do in the note business is actually sending out to IRA investors. That's literally it, because all of our deal flow, for the most part, comes direct from our online marketing via LinkedIn or targeting servicing companies or mortgage bankers that we can find in any state. They have to be registered with that state as a licensed mortgage banker.
Okay, I was just going to ask you that. So going back to when you said you'll get some tapes, I think they call it in the note business. Is that right?
That's
so you get like 200 to 500 of these things on a tape, and you're going through and kind of evaluating them all and doing these kinds of things. And again, I imagine you probably have a system or a VA that can do all of that and then kind of highlight some of the ones that you want to go for.
Yeah, and it's all. I mean, you're getting a spreadsheet, so I always take the OTSC syndrome out of that. Oh, that's so cute. You know what I mean? That property's so cute. I just want to buy it. I'm like, no, don't do that. Do not fall in love with the property. Fall in love with the numbers, the way I look at it. And then let the property. So on this spreadsheet, on this tape, we'll have the borrower's name, how far behind they are, what they owe as far as the unpaid principal balance, potential legal balance, an estimated value of the property. You know what I mean? What the seller will give us. Of course, it's usually Zillow, but we just use that on the front end. We'll always do deeper due diligence. So we can run formulas based on what we think what they tell us as far as pricing. Some of them will say, well, we want full value, which they call par. I'm like, we don't want to pay for par. We want a discount, right? We always want a discount. So running some formulas based on what we would buy that note at, and then what their monthly P&I payment should be, or what we would modify it for. We can run some quick formulas to understand, okay, here's a top 20, here's a top 30 out of this list of 200. And then we just submit a bid in on all 30 of them in just a few minutes, knowing The banks, the lenders are not going to accept all 30. If they did, we probably bid too much, which we okay.
Yeah.
But knowing that out of 30, okay, we get 10 that are accepted. And once those are accepted, then we do the deeper dive. Then we're going to send somebody out to drive by the property and pull a broker price opinion to give us a true value of the property, not a zestimate.
Okay.
We're going to check taxes. We're going to talk to the attorney that's handling it, see how far they are in the foreclosure process, or if they haven't started. If the borrower's filed bankruptcy, like a BK Chapter 13, where are they on the payment plan process? Because we like BKs, because it basically turns into cash flow. If the condition of the property comes back, then what we see the online stuff, we can reduce our bid. If it comes back and there's $6,000 or $10,000 in back taxes owed, we can reduce our bid, and stuff like that.
Okay, because you're going to have to catch them up, right?
Yeah, usually we'll catch them up. Yeah, exactly. So we kind of figured that into our bid to reduce it by taxes owed.
Okay.
But if the property looks good and are a little bit of due diligence on the borrower and the borrower responses, then of course the collateral file, which is this is what we're buying right here. This is a file on a note. This is in Kankakee, Illinois. It was borrower was supposed to pay $578 a month on it. And we paid, what did we pay? We paid $25,000 for this note of $80,000.
Come on now. Come on.
No, yeah, exactly.
Right. All
right. They owed 110. They were upside down, but we bought it at 25. And so at $578 a month, that's their P&I payment. $578 a month. We figured this real fast. $578 times 12 months. That's $69.36. That's a pretty good ROI divided by 25,000, right?
What do we got?
That's a 27.8% cash and cash return to us. Now we got to take some servicing costs out of that.
Still, you're still going to be over 20.
That's what we shoot for. We want to try if we can get them back on track. Shoot for at least a 20% cash and cash return when you figure in servicing costs. And your servicing costs on a non-performing that's about $90 a month. Performing it's $25.
Okay.
If we have to foreclose, that's Illinois is not usually the fastest. Avoid Cook County like the plague, but Kentucky's not bad. So that's going to cost us probably another $3,000 to $5,000 to foreclose, and go from there. So, but my biggest goal is to rehab the borrower, not rehab the properties. I've done plenty of that. We'll still do, there's still deals that we'll just buy to foreclose on to take the property back. If they're vacant or they haven't paid in 5 years, we know we're going to foreclose, or if it's, you guys have a little bit of an older community up in Wisconsin, in Green Bay. So we deal with a lot of reverse mortgages, where the borrower is deceased and nobody's there paying, haven't paid in a couple of years. So we'll buy those and at a big discount with a note that we're just going to have to rehab them and go from there. Okay. But that's the thing. I mean, that's the great thing is you get these lists from banks. Most of the time you can just cherry pick, like I said, if we submit an offer on 30, we're hoping to get 10 back. If we close on 2 or 3 out of those, we're sitting very happy for the most part.
Yeah. Jeez. So 20% plus that's no joke these days. That's pretty tough to get. So that's pretty awesome that you're able to do that and sounds like pretty consistently.
Yeah, we bought over $1 billion in notes in residential and commercial. Commercial is a little bit trickier ball game.
Did you hold on a second, Scott? Back the train up. Did you say billion with a B?
We bought over $1 billion in distressed debt since I started doing this back in.
That's insane, bro.
Yeah,
Holy cow.
We bought a lot of stuff during 2010, 2014. Miami condos for $5,000. You know what I mean? It'd take us 2 years to foreclose, but it was still like I can throw $5,000 after a $50,000 to $200,000 condo and let it sit there for a while and see what it appreciates back to. So
that's insanity, bro. So let me say this: step one, first of all, what you're sharing right now is awesome. Like this is totally making sense to me. I've been in the note realm as far as hearing about it. Like I'm a note supplier, so to speak, as far as doing some private money lending and hard money lending. And I've given people private notes. I've been on that side of things. I've never bought non-performing debt before. So this is a whole new world for me, in which I think I'm going to guess 99% of our audience, this is probably new information for them. And you're breaking it down in a very easy way right now, which is awesome.
We're a much smaller community. I mean, when I started back doing this back in 2007, 2008, there's not really a market for it. I mean, there's people that were around in like the 80s for the savings and loan crisis, the RTZ, the Resolution Trust Corporation, when all the banks were failing and all this distressed debt, stuff like that happened. And then 2008, when everything crashed, we saw more commercial notes than we saw residential because it took longer for the residential stuff to hit the markets as banks were filing bankruptcy and delaying things. But with the commercial defaults, we've seen that taking place since 2020. We've bought a lot of small balance apartment complexes, even like 300 plus units that we bought the debt at a big discount, and then stepped into cash flow or stepped into taking over the complex and working with the borrowers to walk away in a lot of cases. But it's a different market out here. I mean, when we used to buy pennies on the dollars, now it's not like it was 10, 15 years ago, but it's still, 40, 50, 60 cent on the dollar of what's owed is a good price to buy stuff off of value, not overvalued stuff. You know what I mean?
Okay. Got it. So if I wanted, let's say, Scott, I was like, hey, I want to go do this today. Like, I want to start buying some non-performing notes. How do I get this tape, or how do you start? Like, what's step one for somebody out here listening to this that says like, man, this sounds like the lane I want to go down? What's step one besides get connected with you to get some coaching?
Right. There's two paths. And that's one, if you're already targeting foreclosure lists, like you're buying a monthly foreclosure list from a list provider, you can look at that foreclosure list and then look at the lenders or banks that are the foreclosing aspect. Now, I wouldn't target, like I said, the top 5 or 10 banks. And if the foreclosure, like here in Texas, we do everything so fast. If the foreclosure is next month or in 2 weeks, I'm not going to target that bank for that property. I don't care about the property. What I care about is getting the right department in the bank, and then getting their list of stuff all across the country on a regular basis. Okay. So that one foreclosure at 123 Main Street, I'll contact the attorney foreclosing, or I'll call the corporate office, the bank, and the lender, and depending where they're at and how big are they, go by a couple different names. And so you can target the special assets department, the secondary marketing department, the chief credit risk officer. If it's an insurance or REIT, the whole loan trading department. Those are the 4 job titles: special asset manager, secondary marketing manager, whole loan trader, or chief credit risk officer. All right. And you can actually go over to LinkedIn and type in those same names and find people that do all these same jobs, which is the easiest way, right? So that's 2 things. Hey, and it's like just dropping a direct mail. Hey, I saw that you might be the right person handling note sales for ABC Bank. Do you have anything on your books you're looking to get rid of this month or this quarter?
So good. All right, everybody stop, pause, go back, re-listen to that again. Get those titles written down. If you're driving, earmark this part. Go back to it after you got a spot with a pen and paper, because that was just some gold right there. Carry on, Scott.
Yeah, and that's the thing. It's all about drip marketing. I mean, we spend a lot of time on LinkedIn and follow up with people. Hey, what do you have in your books this month? Nothing. You could also go back to the county records. If you go back to the recorder's office and just do a search for assignment search in the last 6 months or a year ago, that will tell you what mortgages have been moved from one lender to another, because it's not a deed, it's an assignment of mortgage that gets recorded that transfers ownership.
Okay.
So whenever I get a list in, that's, we look at, are we direct to the seller? That's an important thing. Who's the lender on this? What's the motivation? How upside down is the bank? There's some things you can do by going to like the FDIC.gov websites, or looking at the bank's quarterly report to see how much distressed debt they have on their books, residential, commercial, and how much of their portfolio is distressed.
Okay.
And that leads to getting a better price. The more distressed they are, the better price we can usually get. Are you saying, when you say the more distressed, you're talking about the bank, the more distressed the bank is itself versus the actual property you're looking at? Exactly. We know the mortgage is distressed, obviously, but a lot of banks, when you understand banks, when they have a non-performing note on their books, they have to hold money back in reserves that they can't lend out.
Yes.
And so that's why banks will often sell to us at a discount, because they'd rather get 50,000 or 50% of the note now. They can go out and rinse and repeat and leverage it 10 to 15, 10 to 50 times, versus holding on to this note. It's going to drag them down, and they have to keep these reserves. So that's the thing to looking at. We don't target like one-off banks because they can't take a big discount. We don't target the top 5 or 10 because they do want you to have $50 million. But there's a whole lot of regional banks, smaller banks, smaller mortgage companies, mortgage bankers that have stuff on their portfolio that they're motivated to move off their bank book so they can move it to somebody else and lend and rinse and repeat and lend on a regular basis.
I love that. When you're doing the due diligence, Scott, you talked about, right? You got the BPO, you're getting done, so you're really getting a true valuation on the property, right? Mm-hmm. Are you able to go in the property ever? Like, are you able to get in there and see like what is the condition of this thing inside? Because that's a great question. Be a big swing if you got to flip that thing.
Yeah, well, that's a great question, and that's the number one question we get from fix and flippers, because you got to have the whole, I got to see everything, right?
Yeah.
And the answer is most of the time, no. If it's occupied, you're not going to be able to go knock on the door. Hey, can I walk in and see the property?
Hi, I'm the bank.
Yeah, exactly. They don't do that. Now, sometimes, of course, if that borrower is listed that property for sale, then you get online photos. You can finagle about that. If the borrower has passed away and it's a reverse mortgage, oftentimes HUD, before they're selling the stuff off, will go in and take photos and send in an inspection,
Okay.
And take a look at it. You can't go knock on the door of the borrower and say, hey, I'm thinking about buying your note. Can you start paying on time again? That's a violation of fair debt collection practices. Although although the CFPB is not really around to step on your toes or swat your hands, you shouldn't do that. But the thing about looking at an asset is that we're literally getting the phone conversations. We're seeing, hey, this borrower called in and tried to talk about doing a loan mod. Or the opposite way, we called the borrower and they told us to F off. You know what I mean? You can, and that's why we send somebody by to look at the property. Is the property in good condition exterior-wise? Is the lawn mowed? Are there toys in the front yard? Is there an American flag out in front? You know what I mean? Is it a good neighborhood, or is it the hood? You know what I mean? Those are important things. And one thing that offsets that fear of, I got a rehab, or if it's trashed outside, is the insurance side of the business. Okay. And when we buy a non-performing note, if the borrower has insurance, which we ask as part of our due diligence, they don't, then what we do before we fund is that we'll put insurance on the property, so that if when we do close on it and the borrower's unresponsive, we go knock on the door. Then if they don't answer, if it's vacant, we're allowed, because we're the bank, to go in, open the door, change the locks, make sure to secure our investment, just like Fannie or Freddie would do on a vacant property.
Any property going up for auction, same look.
Exactly. Yep. So if it's occupied, it's great. I mean, that's when we're calling the utility departments in the city. And since we're the bank and the lender, oftentimes the utility departments will give us more information because we have a vested interest.
Okay.
So like, hey, we're the bank. We're calling to check on 123 Main Street. Corey is the borrower on this. Can you tell us if the utilities are still on? Is the water still on? Oh, it's been turned off. How long has it been turned off? What's the outstanding balance that we would need to pay you when we do that? And so they'll give us information. I had one lady like, oh yeah, they were in here last week. Him and his wife were fighting. They got in a fight. We had to call the cops on them, it's been the same borrower at the house for 4 years. They paid on time. So that tells us a little bit about the interior condition of the property. I mean, I know we're going to usually, if we do take the property back, it's going to be paint, carpet, new appliances 90% of the time. You know what I mean? Yeah. Since we aren't targeting the property, we really base our first line of return on, is it occupied, and what's it going to look like if we can get that borrower back on track? If they just start paying, is that a good day or is it a bad day? Yeah. And going from there.
Well, you mentioned something I think is interesting for the audience to hear. Scott, you said something about and maybe you can expand on this a little bit. There was something about phone records or something you get with this, where they'll actually put notes in the system on this particular borrower, and you get those notes if you're doing your due diligence.
Yeah, it's called servicing notes. So most mortgage companies are going to be servicing a note by calling if you stop paying, right? Okay. So, I mean, we'll see the payment history, all that stuff in the spreadsheet, if what they paid over and that kind of things, which is really nice. But if somebody hasn't paid, then we're really, especially on non-performing note, we're going to look at what's been the conversation. Has the servicing company been reaching out? What's the conversation been? And we'll see notes like bar called in, tried to do a loan mod, bar called in, tried to do a short sale. Okay. Even since we get this collateral file a lot of times, sometimes we'll even get like hardship letters that the borrower sent in. So like I bought this note in South Beloit, Illinois, a few years back, where the file went, the scan file was thousands and thousands and thousands of pages. I was like, why is this collateral file so thick? And turned out this loan had been sold like 5 times over 4 years. And the lady was trying to do a loan mod. And so she was faxing in her W-2s, her hardship letter, her bank statements, all the stuff, trying to get a short sale approved. Okay. And every time she did, the note would be sold to somebody else, and she'd have to do the whole thing again.
Oh my goodness!
So when I saw this, I was like, the lady owed 60. The house was maybe worth 36. It wasn't that high value asset, but they were willing to sell to like 30 cents on the dollar of what they figured. 36 cents on the dollar of what was owed. I'm sorry, of the value of the property. 60 was owed, 36 was the value. So they sell the note to me for 12, and her monthly payment was like $452 a month. And I'm like, I'm like, this lady's been trying to do a loan mod for 4 years.
Yeah.
She's lived in it for 18. In her hardship letter, she laid out, we raised our 3 daughters here. My husband had a heart attack, has been out of work. She even only said, I can't bring the full 4 years or 5 years of back payments to the table, but I can start making on-time payments, get paid a little bit extra. She literally even outlined this in the hardship letter. I'm like, I'm buying this note. So we bought it for 12. The day after we funded on it, I called her up, and her name was Sheila, okay? And William was her name. I'm not going to say the last names, but I can remember talking to Sheila. She picks up the phone, and I say, hello, Sheila. My name is Scott Carson. I'm in the Reverse Asset Fund. I'm calling about your property. And she's like, oh, my God, yeah? So, well, we just bought your note. She's like, oh, you could literally just like, oh, shit, I have to go through this again. And I like, listen, I understand you've been trying to do a loan on this for a while. She's like, yeah. I said, it looks like your loan's been sold like 4 times in 5 years. She's like, yeah. I said, first of all, how is your husband doing? How is William doing? Is he back to work? She's like, oh, you actually read my hardship letter. I'm like, yes, I did. Yeah. Is he back to work? Yes. Okay. I said, this is going to be a good day for you. She's like, oh, really? I'm like, you owe 60. The house is 36. We know you owe 60 because you pulled a little cash out when the value went up a little bit. You know, South Bowl is a little white house. You know, I said, what I said, this is going to be a good day. Can you start paying at $452 a month? She's like, yes, I could do that. Can you bring $5,000 to the table? You know, it's a full year. She was behind by 5 years. She was like, oh, I can't bring $5,000. I said, well, can you bring $2,500 to the table? Yeah. She's like, I can do that. I said, can you pay an additional $200 per month on top of your $452? She's like, yes, I can do that. I said, okay, this is what we're going to do. You bring $2,500 to the table to my attorney's office about an hour south of you. You're going to start making a $652 payment for the next year. After 12 months of on-time payments, we're going to appraise your property and we're going to reduce what you owe down to the true value. So if it goes from 36 to 30, I'll drop your balance to 30. If it goes from 36 to 45, you know, we'll drop it from 60 down to 45 for you. So we'll even take off some of that negative equity. She's like, are you serious? She's like, yeah. And here's the kicker for you, Sheila. You do this on time for 12 months, I'm going to drop your interest rate from 9.9% to 0. She's like, what are you talking about? I said, 0. And we want make on-time payments for 12 months, and we'll drop it down because that way you'll have the house paid off in 72 months instead of 33 years. And I didn't want to own this $36,000 asset, right? But I wanted to make it good. So if you figure the numbers, I paid $12,000. I basically got 90% of my money back in that first year. And then she paid on time for 6 years. Never missed a payment. If she was gonna be like a day late, she would call me like, Sheila, you don't have to call me. Call the servicing company who you're mailing the checks to. And 12 months, after we modified, dropped it to 0, it was like around Christmas time. I got a Christmas card from her and her family. It's a picture of the whole family. And I noticed that one of her daughters in there had a baby.
Okay.
And she's like, we just want to say thank you for allowing us to stay in the house and working with us. Our oldest daughter, who was raised here, had her first child, and we named it Carson after you.
No, come on.
Yeah,
dude.
Man. Serious.
Did that get you teared up, brother?
Oh my God.
That's getting me
I
some
get
chills right
every
now.
time I tell the story, man.
Yeah, dude, that's crazy.
We have the ability to help people stay in their houses, and we prefer that. I want to. About 70% of the time, we keep people in the house. I mean, look, I'm a capitalist pig just like everybody else. I want to make a good return, okay? I made 85% year one on that deal with Sheila, and I think I made like 20% going forward after that for 6 years. She made a ton of money. I mean, there's one lady, it was a single mom of 4 kids in Cleveland. Her house was a POS. I mean, I didn't want to own it, but her husband had left her and all this stuff. She's trying to raise 4 kids, but trying to go to like nursing school.
Okay.
And so we literally we forgave her $20,000 of what she owed on this property and just deeded her the property, the release of lien. I says, Merry Christmas, Happy New Year. I paid like $1,000 for it because it's part of a bulk deal, but it's like, okay. I'll just write that off. I mean, I'm not worried about that. I don't want to own that. And it's, that's the beautiful thing about helping people. Now, sometimes people are just scumbags. We bought one down in near Miami a couple years back. House was worth, when we bought, about $1 million. They owed 1.2 on it. They hadn't paid in 4 years, doing every crazy trick in the book they could to delay the foreclosure process, because Florida is about a 12-month process to foreclose in a good time, right?
Okay.
Well, we bought this note at $440, okay? Borrower just playing tricks, then COVID kicked in. That delayed foreclosures. Yeah, that was a big delay. That we didn't expect that. So it took us another 2 years to foreclose, 2.5 years to foreclose. We foreclosed. We took the property back. They'd moved out. It was immaculate property, but they took about $50,000 worth of rehab, new appliances, and some other stuff. But we listed it for 1.25. We sold it for 1.1 with an offer basically in 10 days. And when you add in legal fees of 2 years and going back to shenanigans, our cost basis was closer to about $800 on that. But
goodness.
So still a very good day, on stuff like that. And you got to expect that you start dealing with higher valued assets. Borrowers are going to hire attorneys to delay foreclosures, and you just have to expect that.
Yeah.
We like to find that the cookie cutter, the best bang for your buck is going to be from that. Really $100,000 up to about $250,000 price range for the most part. If you want to turn into cash flow, you can buy stuff less than that. Contract for deeds, we buy a lot of those as well too for cash flow.
Sure.
But really anything above that, you're probably going to have to foreclose for the most part.
Okay. Got it. Wow, man, that is crazy. So you guys bought it for, what did you say, 440 on that? 1.1?
441.
And you racked up, what was that? Almost like 350,000.
Well, I take that back. Our payoff was that because we did have an investor funded to the deal at 12%. So he funded the deal, and that was with the interest. But we did have over roughly, we had $75,000 to $100,000 in attorney fees for just holding and going that route during the process. So, but we knew that. I was like, when we buy this guy is going to probably drag it out another 2 years, and then COVID kicked in. I was like, oh, thanks God. But we knew we bought it right. I'm willing. We had the attorney review all the legal beforehand, so they said, yeah, this guy's just a creep. He's going to drag it out. He's going to play on it. He showed up, said he was dying of cancer. Then he showed up to the judge and said he didn't speak any English, which was, which he was out in the lobby speaking fluent English.
Wow.
There's some scumbags out there. I don't mind foreclosing on those folks. But
yeah, for sure. Talk about real quick, Scott. I want to go into short sales real quick. So first of all, for the audience that is not familiar with short sales, these were big back in 2010 to 2016, really.
Yeah.
We don't really see much of them anymore, but can you just explain what is a short sale in general terms?
Yeah. So short sales, we're starting to see more come back though in different markets because of values kind of, depreciating a little bit, or markets kind of coming back. Like Austin, we've had a little bit of, they say a crash, but its values kind of dropped down 5-10% in negative growth for the last year or two.
Okay.
Because of the market. But a short sale is where a borrower owes more on their property than the property's worth. So let's just go back to that same number we gave. So it's a $200,000 house. That's what the value is right now. If they haven't paid in a year, or maybe the market dropped, maybe they owe $225,000. Okay. And they don't have the $25,000 and change in their pockets to pay at closing to sell that property, right?
Mm-hmm.
Always got to figure about 9 to 10% for closing costs and commissions on a property anyway.
Yep.
So if we bought that note at 100, okay, I'm the bank. I can kind of help determine the short. Me taking a short really isn't me taking a short. But a short sale is where the borrower it works with a realtor to go to the lender and say, hey, borrower's in trouble, borrower can't pay. We'd like to try to sell this property below what's owed on a technical kind of short, right?
Mm-hmm.
So the lender has to approve. You often see these listed in MLS as third-party approval required. They should be listed no more at 85, 90 cents of the dollar because you want to get foot traffic in. People looking at it, if they're going to have to wait around for a short sale to take place for 90 days of going back and forth negotiations. You want to do it at a discount. Me, if I get, I buy a note and I see it's listed for sale, or the borrower wants to list it, I'll buy it knowing, okay, I bought it at 100. Okay, I'll let you list it for 180. It's worth 200. Mm-hmm. I'll let you list it for 180. Let's get multiple bids to bid it up to 190, 195. Yeah, I'll gladly take a short of 30K, 40K off what's owed because I know I'm going to make 70, 80 in the back end.
Right.
You know what I mean?
Well, what's interesting is I think you're playing chess when other people are playing checkers here with this, because
sometimes.
Where I'm going with this is we run into this, not often, but I would say at least once a quarter, maybe twice a quarter. One of our sellers is in a predicament where they owe. We just had one down in the Milwaukee area. They owed 170. We put it out to the buyers list, just trying to help them more than anything for I think it was 175. Our normal spread on deals is 20 plus. We're not trying to take anything less, but this, we're let's just see if we can help them out. Couldn't get anybody to buy it at those numbers. We had it set up that they could do subject to, so they could take over the mortgage, catch them up on payments. We had all these options, right? To try to help these people out. Nobody was biting, right? So we went to a realtor that we know that does some short sale negotiations, and they tried, and the bank wasn't willing to do really much on it. Where
do you know who the bank was? You know
I don't remember. I don't remember. But what I think is interesting is you're kind of bypassing that step. It seems like of let's go through the realtor to try to negotiate with the bank and try to do a short sale here on the borrower's behalf. And you're going to the bank and providing value and saying, hey, you've got this distressed asset. I'll take it off your plate for you at this, versus just them going through this. Because most of the short sales I've run into is like, if you're less than 80% of what they perceive the value at, they're not willing to play ball.
Yeah.
Where you're getting them at 40 to 60%, it sounds like doing.
It just varies on vendors on a lender by lender basis. You know, if there's a ton of equity, we're not going to get it. We'll probably get a come in at 90 cents of what's owed, even if there's a ton of equity.
Okay.
You know, we don't chase equity a lot of times. Now we had one deal recently. The borrower was in a house, little old lady, been in the house by herself for 15 years. The house was worth $450. She only owed like $175.
Okay.
And I think we paid like $125, $150 for the note. It was still a pretty good deal. In Texas, we can foreclose quickly.
Okay.
And I'm like, well, if we foreclose, we're gonna get $175. That's about $50K before we pay our investors off. I said, we're probably gonna get outbid at the auction. There's no way we're gonna end up taking this asset back at $450, which would be great because we could make a ton. So what we did is we bought the note. We reached out to the borrower, said, hey, what do you want to do? Do you want to stay? Do you want to go? She's like, well, I don't want to stay. But I'm worried, I don't want to necessarily, she's old enough. She could have done a complete reverse mortgage and stayed in the house, tapped in that equity, could have stayed. We even offered that. Didn't want to do that. I said, okay, well, what if we do a friendly foreclosure? She goes, what do you mean by that? I said, how about we give you some cash to walk? So we avoid it going to the foreclosure auction and getting outbid and somebody else making the lion's share of the profit. So she's like, what do you have in mind? I said, well, we went back and heat and hot a little bit. I said, how about we give you $75,000 to sign the property over and walk away? And she's like, that would be great. So we gave her $1,000 to sign, got her out of the house, got her into an apartment. She still had some money and some friends, so we got into that. Then, since we were the bank, she deeded the property back to us. So now we didn't have to worry about foreclosing because we did a friendly foreclosure with her.
Okay.
Put $20,000 in rehab, paint, carpet, new appliances, and listed it for $450. And it got a full price offer in 7 days.
Oh my!
So we ended up making more money on the back end side of that versus just the $50,000. And we actually did some good, gave her some cash. Because here's the thing: not everybody would have done that. Most people would just foreclosed, and she would have probably not gotten anything at the auction.
Right.
And run that risk. And this way, we were able to help a lady out, make some lemonade out of lemons. You know what I mean?
Yeah, man, I love it because what you're able to do is everybody's winning. That's always what I always say is a great real estate transaction was everybody leaves that table feeling like they all won, right? Yeah. In some aspects, right? Nobody's feeling like they got taken advantage of or anything like that. And in our business, in the wholesale business, that can sometimes some you meet with the sellers, then they get sad, or somebody talks to them, and then they want more money, and yada yada. And that's when sometimes our deals can get a little messy. But typically, these people are thanking us up and down at the closing table, and they're excited, and we're excited. And sometimes real estate agents that I talk to, they think we're the scum of the earth and we're ambulance chasers and all this stuff. They don't understand. They don't get to see these sellers in tears when they're getting this problem property off their plate, and they didn't have to go through the traditional route and that kind of thing. And you're doing the same thing with notes here. It sounds like you're able to come into a position where somebody's stressed out of their mind about getting foreclosed on and what it's going to do to their credit, and are they ever going to be able to get a place, and blah, 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 blah. And you're able to help keep a lot of these people in their houses and make a profit for you and your investors.
Yeah, exactly. That's the thing. If you think about what damage a foreclosure does, not only to a block, but a market, it really depreciates the whole block. Loses $10,000 in value on a foreclosure or more, depending on what happens at the auction.
Sure.
So we're able to kind of keep that up,
Yeah.
If instead of foreclosing, we can still do a friendly foreclosure, and then the price isn't listed anywhere. And then selling it at full value after we cleaned it up boosts the actual economy, boosts the valuation and stuff like that. But there's still people that, we still have to foreclose on 25, 30% of the time. They don't want to work with us. They don't want to communicate. I had a guy just recently called me the week after the foreclosure auction. Isn't it always when people call off a foreclosure list, they call the week after the auction? Hey, I need help. It's too late.
Now I want to work with you. It's like, buddy, what are you doing?
Too late. I'm like, man, you didn't communicate with us for 2 years. I said, I'm not, I don't feel sorry for you. Well, I got little kids. I'm like, I'm sorry, man. I don't feel sorry for you. We send out door knockers. We, flew a plane by. Please call us at this number.
Yeah.
Unfortunately, I mean, and that's the thing is, too, people always ask me, what does the market foretell? Are we going to see more foreclosures?
Mm-hmm.
You're not going to see foreclosures. You're going to see more things where banks are selling the portfolios of the debt off to investors like me because they don't want to necessarily be on the hook for the foreclosures, and it costs them a lot more to rehab the property. It's vacant for a while. A vacant property is a non-performing asset on the bank's books. Banks don't really want to own foreclosures, whether you believe it or not.
They learned that in 2008. They don't want.
They're not.
They don't want to own them. Yeah.
No, they do not want to own them. Calling the bank, say I want to buy ARIAs, they're just going to send you to a voicemail box. But if you reach out to the right department of the banks, like I said, and said, hey, I want to buy your non-performing notes for my own portfolio. I mean, you can wholesale notes just like you wholesale real estate too. It's very simple.
Yeah.
But it's all about buying for your own investment. And then the banks actually like to hear you say, hey, we're trying to keep people in their houses. If they won't play ball, obviously we'll foreclose and go that route. But since we're kind of that smaller war dogs living on crumbs kind of mentality aspect, we have a lot more flexibility in what we can do and some more options that we can offer the borrower to try to work with them.
Yeah, that's awesome, Scott. Well, if somebody wanted to get some help on this stuff, Scott, because this is awesome. Like, this podcast has been great. This is one of my favorite episodes so far because I'm learning a ton about this whole different world in real estate. I know you offer some, you have Monday nights. Are you still doing the Monday night?
Yeah, we've got a ton of videos. We've got the #1 YouTube channel, #1 podcast out there with the Note Closure Show, stuff like that. We broke down 187 notes last Monday night.
Wow.
For people to take a look. We're only one of the few people out there that actually will bring up a tape and literally go through, hey, here's where the deals are. Here's the duds. Avoid this and avoid that. We've got a free course, a free 3.5-hour course for you to learn about the basics of note investing. If you're interested, just go to noteweekend.com.
Sweet.
You can register. It'll send you the replay. I actually just taught it live this last Saturday for 3 hours to people on how to find, fund, and flip these deals.
Nice.
And then, of course, we have quarterly classes and coaching and stuff like that. But
awesome.
If you really like this, you can use your IRA. You can use OPM. Don't let what you have or don't have in your checking or savings account stop you from doing it, because there's a lot of good deals out there. And you and I both know, Corey, we wouldn't be where we're at if we just tried to use only our money over the years, right? You got to use other people's money. So
That's right. I mean, I think that's such a great point to make, because I think that's one of the limiting factors when, for 99% of people, we don't have rich uncles who gave us a bunch of cash, and we weren't blessed with trust funds. It's all self-made, and you got to realize, like, I wouldn't own over 100 doors just with cash that I had sitting in the bank account. It doesn't happen without using private money or leverage or creative financing or community banks that'll fund it all. Like, there's a million different ways to do it. So if you've got grit and you've got a strong intensity to change your life, it's all about getting connected with the right people who've already done this before. And Scott's one right here that we're bringing to you guys today on the Wisconsin Investor, that he can help you guys and guide you. And I'm definitely going to be going out there to noteweekend.com, and I'm going to be getting myself that little 3.5-hour course. And
well, you and I have already talked. Anything I see up in your neck of the woods, Green Bay, Wisconsin, or Milwaukee, I'm going to shoot it to you.
Let's go, buddy,
and partner up with you on some of these.
Let's go. Let's do a little. We'll do a little case study then, Scott. We'll promote that baby out to the audiences and show them how we do it. Go from 0 to 1. Yeah. Let's do it, man. If somebody wanted to get in touch with you, Scott, what's the best way for them to reach out to you if they have questions on this or have more information? Is it go to the YouTube channel? Is it what's the best way?
If you go to our website, weclosenotes.com is always the easy spot there, or you can always book a call directly on my calendar on there by going and just booking a call with me, or going to talkwithscottcarson.com. That'll take you directly to my calendar and book a phone call. And I'm always glad to let you pick my brain for 30 minutes or ask me questions. And it's a great thing. It's not for everybody. I'll tell you that right now.
No.
If you're an engineer and have an engineering mindset, you might freak at all the different opportunities, and structure stuff like that. The riskiest part of note investing is making sure you're buying the right price. Never buy a note you don't want to end up owning.
Okay.
Always check taxes. Always check title. If you do those things, you're going to be pretty well off, because most times you're buying at a discount. Worst case, you sell the note to somebody else and get paid back and moved on there. People screw up because they come from, I got to do everything myself. I got to handle the workout. I got to try to handle the foreclosure. I'm like, no. Pay the $90 a month to a servicer, pay the attorney their $2,000 or whatever, let them foreclose, and let's move on. You don't run a charity. You donate to charities, because people will try to drag the shit out by, oh, you don't want to foreclose on me? Yes, I do. Pay, stay. You know what I mean?
I love it, man. Well, we've been talking a lot on the recordings lately about one of my favorite books, Who Not How, and that's what it sounds like. As we were talking, I'm like, well, this sounds like a who thing. I could get a VA.
Totally.
You know, my brain is going like, I could get a VA to get all the basic stuff. Then all I got to do is make the final decision. Then we got a servicing company, attorney, title company. Like, it's just a who thing. It's just getting your team set up, and I'm sure you can help structure that for anybody who's interested.
Yeah, it's pretty easy.
Scott, we always wrap up with a little fun question here. And I know I prepped you a little before this because you're from Austin, Texas, but you did have a pretty good one when I asked you the final question, the favorite place to visit or Wisconsin tradition. Tell the audience a little bit about what you got here, man.
So my family's originally from the land of 10,000 lakes, your neighbor, to the west, Minnesota, I was born in Rochester and Stewartville and stuff like that. I'm actually going back up there here in a couple weeks, but one of my favorite memories as a young kid, I love apples. I love fruit. Is going to an apple festival right on the border. We were in Wisconsin, some city named Last Valley. You mentioned it, and I think Hudson. I think Hudson Valley. Yeah. And I remember walking through this apple festival, and there's literally like hundreds of booths of apples. It's like I remember eating so many apples, I got sick on the way home and stuff like that. But my mom and I got an uncle that lives in Wisconsin, and there's nothing beats good cheese curds. It's just one of the great things when you get a good cheese curd.
Yes.
Up there, the milk tastes different. Just the greenness of it. Farmers in the dairy land up there are the salt of the earth. We got to protect those folks.
I agree 100%. I agree. Guys, if you got some value out of this and you want to help the audience or help other people get started in real estate, share the episode, guys. Go out, follow Scott as well. I mean, he's got tons of great, if you don't know where to start, this guy's got a ton of content he's cranking out. So you will not fall short of any kind of education gap here if you follow Scott. So go follow him on his different platforms and on the links that he gave us. We'll put all those in the show notes as well. So if you forgot all those, we'll have those in there. And then if you guys share this episode, remember that's going to help you guys raise private money. It's going to help people tell you what you're into. They're going to know you're into real estate investing, and you're going to start more conversations that is ultimately going to help you build your network out there. So if you're not ready to get on the buyer's list, like I mentioned at the start, but you do want to just start having some conversations like this, obviously Scott made a generous offer today. We're also willing to have some conversations about how to help you get started here in Wisconsin on some of your real estate investing. You can just go to the WisconsinDiscountProperties.com website. Just go to the contact us page or give us a call on the website on top, and we'd be happy to have that conversation if you're not quite ready to start evaluating deals yet. Scott, this has been awesome, man. I appreciate you being on, brother. Any last words for the audience here before we roll?
Just get out for your ass and take some action. No matter what it is, reach out. Those that are most successful are the ones that are most giving of their time to help make sure that you avoid the pitfalls or the hurdles that we hit when we get started.
Yep. Awesome, buddy. Appreciate you being on. Thanks, guys, for listening. We'll see you on the next episode.